Amazon. Now, Jeff Bezos on the Twitter was saying like 2 weeks ago, basically recession is all but certain. The stock is on pace for its worst year since the internet crash of the year 2000, but you say you got to buy it. Why?
Look, I think that Amazon is getting unfairly punished for guiding down, and it's not that surprising. Everybody right now is guiding down because if we aren't already in a recession, we're probably going to get there pretty quickly with the determination that Chair Powell has to continue to fight inflation with higher rates. And so if you look at performance by Amazon, it has been fantastic. If you look at expected performance for Amazon, it continues to be great. And so I think that a lot of this is just that they had an extraordinary pandemic. They are going to start slowing a bit, but the expectations are still amazing, and they look really cheap compared to, even if you take into account we are now in a higher interest rate environment and we're probably going to normalize at a higher interest rate environment. We've taken that into account, and we still think that Amazon is cheap here.
All right, next buy is Microsoft, pacing for its worst year since 2008. That's pretty much every stock but oil and gas. So, Gina, on Microsoft, make your PowerPoint. Sorry.
So here's my pitch on Microsoft. Look, Microsoft is suffering from some pandemic pull forward. A lot of people ended up having to get ready for remote work, deal with remote work, upgrade their systems throughout the pandemic, and they're starting to see a glut of spending expected next year. And so the projections for next year are modest but positive, but very low by Microsoft standards. And I think that if you look at what's happened to the stock, they have more than priced that in. Microsoft is an absolute steal. It's 21 times forward earnings for a stock that has tremendous growth and where the cloud story is not going away. I think we'll have low earnings next year, and I think that that will pick up and we'll get back to a more normal rate where spending is necessary and, quite frankly, is important to most corporate backbones. And so you're not going to get away with not spending money on Microsoft. So I think 21 times is a steal. Yeah,
and we showed our mystery chart before the break. The stock is down. It's Adobe, but another one that you like. I'm noticing a trend here, kind of companies that are best in class, don't have a monopoly, but it's not a monopoly.
They're pretty strong companies. If they're not a monopoly, they're really close. And Adobe is one that continues to expand and revolutionize, their brand, their offering, and their, quite frankly, just their whole subscription model has really, really improved over the course of the pandemic. They went head to head with MyBale, which is to add, signing capability. They just bought Figma. This is a company that's continuing to expand. They've had a tough year, and that's one of the reasons that they're down, but they're trading at 18 times forward earnings. And next year's expectations are very strong. And so, here, again, is one that is going to come back. And that's the theme here, is we're investing in companies that are going to survive the recession.
All right. Those are your buys. Amazon, Microsoft, Adobe. This is your bail. It is DocuSign. I got to imagine the COVID pandemic, whatever, over. Also, housing. Ouch.
Yeah. That was a big driver for DocuSign. It was a pandemic darling for lots of reasons, but refinancing, buying homes, and being able to process those through DocuSign was a huge mover. And now the refinancing market is all but frozen. And this is a company that really only offers one thing, and one thing that was quickly replicated by another company, Adobe. And so expectations for sales and revenues next year and earnings are terrible. I mean, literally like minus 400%. This is a company that you want to get out of before it disappears.
Shepard Smith here. Thanks for watching CNBC on YouTube.